Welcome back to the Profitable Mindset Podcast, everyone. Today we're going on a journey through time to explore the fascinating history of the financial market. We'll uncover how it evolved from its earliest forms to the complex system we see today. And I think you'll find, as I did, that understanding this past can offer some really valuable insights for navigating the modern financial world.
Yes, exactly. The financial market we know today is a result of centuries of innovation, experimentation, and let's face it, a few missteps along the way. But those missteps are just as important as the successes because they teach us so much about how money and markets really work.
So let's rewind all the way back to a time before money as we know it even existed, back to the barter system. Now on the surface, it seems pretty straightforward. You have something I want, I have something you want. We trade. Simple, right?
Well, in theory, yes. But the barter system is riddled with inefficiencies, especially as societies grow and trade becomes more complex. For example, imagine you're a farmer with a surplus of grain and you need a new plow. You have to find someone who not only needs grain, but also happens to be a blacksmith willing to trade a plow for your grain. That's the double coincidence of wants, and it's incredibly limiting.
It's like trying to find a needle in a haystack. Not to mention the challenges of figuring out the value of each item in the trade. How many sacks of grain equal one plow? What if you only need a small repair on your existing plow? That's where the problem of indivisibility comes in.
Exactly. A cow, for example, is not easily divisible. You can't just trade half a cow for a basket of apples. And even if you could, who decides what portion is a fair trade? This lack of a standardized unit of value made bartering incredibly cumbersome and ultimately unsustainable for larger scale economies.
So as trade expanded and societies became more sophisticated, people needed a more practical and efficient way to exchange goods and services.
Absolutely. This need led to the emergence of what we call commodity money. People started using items with inherent value, things like shells, salt, and various metals as mediums of exchange. These commodities were generally more durable, divisible, and recognizable than bartered goods, making trade much smoother.
It's fascinating to see how societies across the globe, often independently, came up with similar solutions to the same problems.
Yes, the use of commodity money really highlights how human ingenuity consistently seeks out ways to overcome obstacles and facilitate progress.
Okay, so people started using commodities as currency, but eventually societies gravitated towards certain metals, particularly gold and silver, as the preferred forms of money. Why was that?
Gold and silver had qualities that made them particularly well-suited as currency. They were relatively scarce, durable, portable, and easily divisible, making them ideal for transactions. Plus, they held their value well over time, unlike some other commodities that might perish or fluctuate wildly in value.
It seems like a natural progression to go from bartering to commodity money and then to settle on precious metals like gold and silver as the foundation of a monetary system.
It was a crucial step in the development of more complex financial systems, but even using precious metals had its drawbacks. Imagine lugging around heavy sacks of gold or silver. To make a large purchase, it was cumbersome and risky.
Not to mention the time and effort involved in weighing and verifying the purity of every piece of metal in each transaction. There had to be a better way.
And there was, around 600 BC. The Lydians, in what is now modern-day Turkey, introduced something revolutionary: coinage. They began minting standardized pieces of electrum, a naturally occurring alloy of gold and silver. These coins were stamped with a mark to guarantee their weight and purity.
That's a game changer. Coinage not only addressed the portability issue, but also helped establish trust in transactions. No more questioning whether you're getting what you paid for.
Precisely. It was a huge leap forward. Coinage streamlined trade, reduced uncertainty, and paved the way for even more sophisticated financial systems to develop.
And this innovation, like many others in financial history,
spread rapidly.
Yes, the Greek city-states, the Persian Empire, and later the Roman Empire, all recognized the advantages of coinage and adopted it as their primary form of currency. It fueled trade, fostered trust, and played a key role in the economic expansion of these empires.
It's amazing to think how this simple yet brilliant idea from thousands of years ago laid the foundation for so much of what we take for granted in our modern financial systems. But coinage was only the beginning, right?
Exactly. Once you have coins, you need somewhere safe to keep them. And that need led to the rise of another crucial player in the financial world, banks.
So where did banking begin? Were there banks in ancient times?
Well, the earliest forms of banking emerged from a need for safekeeping and lending. Temples and palaces in ancient civilizations often served as secure repositories for valuables. including gold and silver. These institutions also began to engage in lending activities, providing loans to individuals and even governments.
So the concept of safeguarding assets and providing credit was already present in ancient societies. Yes. It's fascinating to see how those basic financial functions were already in place centuries ago. But it was during the Middle Ages that we start to see the emergence of institutions that more closely resemble the banks we know today.
Tell me more about that.
Well, during the Middle Ages in Europe, goldsmiths, who already had secure vaults for storing their precious metals, started accepting deposits from merchants and other individuals for safekeeping. They would issue receipts for the gold deposited, and these receipts gradually began to circulate as a form of paper money. Essentially, people started trading these receipts as a more convenient and less risky alternative to carrying around large quantities of coins.
It's amazing how something as simple as a receipt could evolve into a form of currency.
It really highlights how financial innovation often stems from practical needs and the desire for greater efficiency and security.
And this practice of issuing receipts for gold deposits essentially marked the birth of modern banking, didn't it?
It was a pivotal step, these goldsmiths, realizing that not everyone came to withdraw their gold at the same time, began to lend out a portion of the deposited gold and charge interest. This practice, known as fractional reserve banking, became a key feature of modern banking systems.
So they were lending out money that didn't technically belong to them. That sounds incredibly risky.
It was risky, but it also proved to be a powerful engine for economic growth. This practice of lending out a fraction of deposits allowed banks to create credit and stimulate investment, fueling economic activity.
It's like creating money out of thin air.
Well, not entirely out of thin air. It's more like leveraging existing deposits to multiply the amount of money circulating in the economy. But it definitely marked a shift from simply safeguarding assets to actively managing and creating credit.
And this innovation led to the establishment of more formal banking institutions.
Right. Yes. As the practices of deposit taking and lending became more widespread and sophisticated, we see the rise of institutions like the Medici Bank in Florence during the Renaissance. They went beyond simply storing and lending money. They financed trade, wars, even the arts, showcasing the expanding power and influence of these early banks.
The Medicis were incredible. They weren't just bankers. They were patrons of the arts and influential figures in Florentine politics.
Absolutely. Their story really illustrates how intertwined finance, power, and culture have always been.
And as banking practices continued to evolve, institutions like the Bank of Amsterdam emerged in the 17th century. The Bank of Amsterdam was renowned for its stability and reliability because it maintained full reserves of gold and silver for every deposit, unlike the fractional reserve system that was becoming more common.
The Bank of Amsterdam served as a model of financial prudence during a time when banking practices were often opaque and prone to risk. Their commitment to transparency and sound financial management helped solidify public trust in the banking system.
And then, of course, there's the Bank of England, established in 1694. Initially, it was tasked with managing government debt, but it eventually took on a much broader role in the financial system.
The Bank of England became the prototype for modern central banking. It issued banknotes, influenced interest rates, and established the groundwork for the monetary policies that governments use today to manage their economies.
It's incredible to see how these early forms of banking, born out of simple necessities, eventually evolved into the complex financial institutions we interact with every day. But before we dive into the rise of stock markets, let's explore another key element in the early stages of financial development: commodity markets.
Commodity markets played a vital role in early economies. They facilitated the exchange of essential raw materials, everything from agricultural products like grain and livestock to precious metals like gold and silver.
These markets were essential for everyday life and economic growth. But it wasn't just about trading everyday necessities, was it? There was also a flourishing trade in luxury goods and exotic commodities.
You're right. The allure of spices, silk, and incense from the East fueled the establishment of vast trade routes, like the Silk Road, connecting distant cultures and driving economic prosperity.
The demand for these luxury goods was incredible. It's fascinating to think how the desire for spices, silk, and other exotic items could spur such large-scale economic activity and cultural exchange.
Absolutely. And this demand for exotic commodities also spurred the development of new financial instruments, like bills of exchange. These bills allowed merchants to finance their long voyages and manage the risks associated with long-distance trade.
So even in these early stages of financial development,
Wow.
we see innovation and adaptation in response to market demands.
Exactly. And as trade in these essential goods continued to grow, the need for more formalized systems became apparent. This led to the emergence of dedicated commodity exchanges, like the Chicago Board of Trade in the 19th century.
The CBOT was a game changer for commodity trading. It standardized futures contracts, which allowed farmers and merchants to lock in prices for future delivery of their goods, mitigating the uncertainty of fluctuating markets.
The introduction of standardized contracts was crucial. It brought greater transparency and efficiency to commodity markets, attracting more participants and contributing to their growth.
So just like with the development of coinage and banking, we see how the need for stability, efficiency, and risk management drives innovation in the financial market.
Absolutely. And this drive for innovation and adaptation continued as the world entered a new era of unprecedented technological advancement, the Industrial Revolution.
Now that's a pivotal moment in history. The Industrial Revolution not only transforms industries and economies, but also revolutionized how companies raise capital. It's a story filled with ingenuity and a relentless pursuit of progress. We'll have to save that fascinating chapter for our next episode. Stay with us.
Sounds good. Welcome back to the Profitable Mindset podcast. Before the break, we were discussing how the need for stability and risk management drove innovation in the financial markets, leading up to the Industrial Revolution.
And the Industrial Revolution really was a turning point, wasn't it? It wasn't just about new machines and factories. It was about a whole new way of thinking, about production and finance. I mean, think about the sheer scale of the projects. Railroads, massive factories, mining operations, it all required enormous amounts of capital.
You're absolutely right. The Industrial Revolution created this unprecedented demand for capital, and traditional funding sources simply couldn't keep up. Family money or small loans weren't going to cut it anymore. Businesses needed a way to access larger pools of capital, and that's where joint stock companies came in.
Joint stock companies, the precursor to the modern corporation. Explain how that worked.
It's essentially a joint stock company, allowed multiple investors to pool their resources by purchasing shares in the company. These shares represented ownership in the company and could be traded on stock exchanges. It was a brilliant way to spread risk and attract the large sums of capital needed to fund those ambitious industrial projects.
So instead of one person or a small group bearing the entire financial burden, risk and reward were distributed among a larger group of investors. That makes a lot of sense.
Exactly. And this innovation fueled the growth of stock exchanges, like the London Stock Exchange and the New York Stock Exchange. These exchanges became bustling hubs for buying and selling shares, connecting businesses in need of capital with investors seeking returns.
I've always been fascinated by the story of the railroads. They were at the forefront of the Industrial Revolution, connecting distant markets and transforming the way we lived and worked. But laying those vast rail networks required an incredible amount of capital, didn't it?
Railroads were some of the first industries to heavily rely on stock and bond markets for funding. Investors saw the potential for enormous profits and poured their money into these ventures.
It was a risky, but ultimately rewarding investment. The expansion of railroads played a huge role in fueling economic growth across the globe.
And it wasn't just railroads. The textile industry, manufacturing, mining, all of these key industries of the Industrial Revolution relied heavily on capital markets to fuel their expansion.
This period also saw the emergence of some exciting new financial instruments. I remember reading about stock splits and dividends becoming popular around this time.
Yes, stock splits made shares more affordable for smaller investors, broadening participation in the market and further democratizing access to capital.
It was a win-win situation. Companies could raise more capital and more people could participate in the potential growth of these businesses.
Exactly. And dividends provided a way for companies to share profits with their shareholders, making stocks even more appealing as investments.
It seems like there was a lot of creativity and innovation in the financial markets during this period.
There was. And let's not forget about preferred shares. These offered investors fixed dividends and priority over common stockholders when it came to receiving those dividends, and any assets if the company was liquidated. It was a way to appeal to investors looking for more stable returns.
It's incredible how this period of industrial and technological innovation spurred so much creativity in the financial markets as well.
The Industrial Revolution was a time of tremendous change, and the financial markets adapted and evolved to meet the needs of a rapidly changing world. But this period of rapid growth also exposed some of the limitations of the existing monetary system.
You're talking about the gold standard, right? For centuries, precious metals like gold and silver served as the foundation for currencies across the globe. But as economies grew and the demand for credit increased, the limitations of a gold-backed monetary system became more apparent.
Exactly. The reliance on a finite supply of precious metals could constrain economic growth, particularly during periods of rapid expansion, like the Industrial Revolution.
It's like trying to build a skyscraper on a foundation meant for a small house.
That's a great analogy. And throughout history, there had been experiments with paper money. Early forms of paper currency appeared in China and later in Europe with banknotes, issued by banks like the Bank of England. But these early forms of paper money were often viewed with suspicion because they weren't directly backed by gold or silver.
So the idea of paper money wasn't entirely new, but its role in the global monetary system was about to undergo a radical transformation.
Yes. During the 19th century, the gold standard emerged as a dominant force. In the international monetary system, it brought stability and predictability to currencies and facilitated international trade by creating fixed exchange rates between different currencies.
It sounds like a pretty solid system. Why did it eventually get abandoned?
Well, while the gold standard did provide stability, it also introduced a certain rigidity into the system. Governments couldn't adjust monetary policy as freely to respond to economic shocks or crises. The Great Depression, which began in 1929, really exposed this weakness.
I can see how a fixed currency tied to a finite supply of gold could be problematic during a severe economic downturn.
Exactly. During the Great Depression, many countries faced deflationary pressures, meaning that prices were falling and economic activity was slowing. But under the gold standard, governments were limited in their ability to stimulate the economy by increasing the money supply, because they couldn't simply print more money without having the gold reserves to back it up.
It was the very system
Yeah.
that was designed to provide stability ended up hindering governments' efforts to address the crisis.
Right. The Great Depression forced many countries to abandon the gold standard and explore alternative monetary systems, and this led to the adoption of fiat money. In the 20th century,
Fiat money. That means the value of the currency is not tied to any physical commodity, like gold or silver. Instead, its value is derived from government decree and the faith people have in that government's ability to manage the economy.
Exactly. And this shift to fiat money gave governments and central banks far greater control over monetary policy. They could adjust interest rates, manage the money supply, and implement strategies to stimulate the economy without being constrained by the limitations of a gold-backed system.
It was a significant shift in how we think about and manage money, but this new system also brought new challenges, didn't it? Managing fiat currencies effectively requires a great deal of responsibility and careful planning.
You're absolutely right. It requires a delicate balance to control inflation, manage debt levels, and ensure the stability of the currency. It's an ongoing challenge for policymakers and central banks around the world.
And as we move into the 20th century, we see another major force shaping the financial landscape: globalization. As economies grew and became more interconnected, so did the need for efficient cross-border transactions.
Absolutely. The increasing flow of goods, services, and capital across borders required new institutions and mechanisms to facilitate international trade and investment.
This era saw the emergence of organizations like the International Monetary Fund, IMF, and the World Bank, which play key roles in promoting global financial stability and economic development.
And these institutions provide loans, technical assistance, and policy guidance to countries around the world, helping to manage global financial flows and address economic crises.
And technology has always been a driving force in the evolution of financial markets. As globalization accelerated, so did the pace of technological innovation.
Yes. The telegraph revolutionized communication in the 19th century, allowing for nearly instantaneous transmission of information across continents. This dramatically sped up transactions and the flow of information, connecting global markets in ways that were previously unimaginable.
And then came the telephone, which further accelerated communication and deal-making. I can't imagine trying to do business across borders in the 19th century without these innovations.
It would have been incredibly slow and inefficient. And then, of course, the arrival of computers transformed trading altogether. Computers introduced automation, sophisticated data analysis, and the ability to process vast amounts of information in real time.
Computers led to the development of electronic communication networks, ECNs, which made trading faster and more efficient, removing geographical barriers and connecting buyers and sellers from around the globe.
Right, and we also saw the development of sophisticated financial models and algorithms, which could analyze data and make predictions about market movements with increasing accuracy.
And then came the internet, which truly democratized access to information and global markets.
The internet was a game changer. Online trading platforms gave retail investors unprecedented access to global markets and real-time information.
It leveled the playing field, allowing individuals to participate in the financial markets in ways that were previously limited to large institutions and professional traders.
Yes, and this accessibility also brought about a whole new era of trading strategies and technologies.
We saw the rise of high-frequency trading, HFT, where powerful computers execute trades in fractions of a second, capitalizing on tiny price discrepancies.
And algorithmic trading, which uses complex algorithms to make trading decisions based on preset parameters, became increasingly popular. These technologies dramatically increased market speed and efficiency, but they also raised new questions about fairness and transparency.
It's a fascinating paradox. Technology can be a powerful tool for progress and democratization, but it can also create new challenges that require careful consideration and potentially new regulations.
Absolutely. And this interplay between innovation and regulation is a theme that continues to this day, especially as we explore the potential of emerging technologies like blockchain, cryptocurrency, and artificial intelligence in financial markets.
It's a dynamic and ever-evolving landscape. But let's not forget that alongside these incredible innovations and advancements, the history of financial markets is also marked by a series of crashes and crises that have forced markets to learn and adapt.
You're right. Throughout history, we've seen recurring patterns of speculative bubbles and market crashes. From the tulip mania in the 17th century to the dot-com boom and bust in the late 1990s and early 2000s.
These bubbles typically follow a similar pattern, don't they? There's an initial wave of excitement about a new innovation or opportunity, which attracts investment. Prices start to rise, drawing in more investors, creating a feedback loop of increasing demand and rising prices.
Exactly. And then comes the euphoria stage. Everyone is convinced that prices will continue to go up forever. The fear of missing out takes hold, and people start investing recklessly, often with borrowed money, driving prices to unsustainable levels.
And eventually reality sets in. The bubble bursts. It could be triggered by a change in sentiment, a piece of bad news, or simply the realization that prices are completely detached from any real value.
And when that happens, panic selling takes over, prices plummet, and a lot of people get hurt.
The Great Depression, triggered by the stock market crash of 1929, is a stark reminder of how devastating these crashes can be. It wasn't just a financial crisis, it was a global economic catastrophe that led to widespread unemployment, poverty, and social unrest.
The Great Depression was a turning point in financial history. It highlighted the need for greater regulation and oversight of financial markets to protect investors and prevent future crises.
That led to some landmark reforms, like the Glass-Steagall Act in the United States, which separated commercial banking from investment banking, and the establishment of the Securities and Exchange Commission, SEC, to regulate and oversee markets.
These reforms were designed to promote transparency, prevent conflicts of interest, and protect investors from fraud and manipulation.
They were crucial steps in restoring public trust in the financial system after the devastation of the Great Depression.
Absolutely. And these regulations, along with other measures, helped to bring greater stability to the financial markets for several decades. But it's important to remember that regulation is an ongoing process. As markets evolve and new innovations emerge, regulations need to adapt to address new challenges and risks.
And we saw this need for ongoing regulation play out in the decades following the Great Depression.
Yes, despite the reforms put in place after the Great Depression, financial markets continued to experience periods of volatility and crisis.
For instance, the Black Monday crash of 1987, when stocks markets around the world experienced their largest single-day percentage decline in history, was a stark reminder that markets could still be vulnerable to sudden shifts in sentiment and technological glitches.
The Black Monday crash was exacerbated by program trading, where computers were programmed to automatically execute sell orders when certain price thresholds were met. This created a cascading effect, with selling begetting more selling, leading to a rapid and dramatic market decline.
It highlighted the potential risks of automation and the need for safeguards to prevent unintended consequences.
Absolutely. And then, of course, there's the 2008 global financial crisis, which had its roots in the U.S. housing bubble.
The 2008 crisis was a complex event with multiple contributing factors, but at its core, it was a crisis of excessive risk-taking, fueled by loose lending standards, complex financial instruments, and a belief that housing prices would continue to rise indefinitely.
You're right. Financial institutions were heavily invested in mortgage-backed securities, which bundled together thousands of individual mortgages. These securities were initially seen as relatively safe investments, but they became incredibly risky when the housing bubble burst and defaults on mortgages skyrocketed.
The crisis highlighted the interconnectedness of the global financial system and the potential for a crisis in one part of the world to rapidly spread across borders.
It led to massive government bailouts of financial institutions, unprecedented interventions by central banks, and a global recession that had a profound impact on economies and societies around the world.
The 2008 crisis also led to calls for stricter regulations and greater oversight of financial institutions.
Yes, in the aftermath of the crisis, governments around the world implemented a range of reforms aimed at strengthening the financial system.
And preventing future crises.
In the United States, the Dodd-Frank Act was passed in 2010, introducing a wide range of reforms to address the issues that contributed to the crisis. It created the Financial Stability Oversight Council to monitor systemic risks, established the Consumer Financial Protection Bureau to protect consumers from abusive financial practices, and implemented stricter regulations for banks and other financial institutions.
And internationally, the Basel III Accords, developed by the Basel Committee on Banking Supervision, introduced stricter capital requirements for banks to make them more resilient to financial shocks.
These reforms aim to make the financial system more transparent, accountable, and resilient. But the debate over the effectiveness and unintended consequences of regulation continues. It's an ongoing process of learning and adaptation. As markets evolve, new innovations emerge, and the global economic landscape shifts, we'll continue to face new challenges and risks.
And speaking of evolving, let's discuss another financial innovation that's had a huge impact. Derivatives. These financial contracts derive their value from an underlying asset and have been used for centuries to manage risk.
Derivatives, like forwards, futures, options, and swaps, can be powerful tools for hedging price discovery and even speculation. But their complexity and potential for misuse have also contributed to financial instability.
It sounds like a classic example of the double-edged sword of financial innovation.
Exactly. For example, a farmer might use futures contracts to lock in a price for their crops months in advance, protecting themselves from potential price declines. But a hedge fund might use those same futures contracts to speculate on price movements, potentially amplifying market volatility.
The 2008 crisis highlighted the risks associated with complex derivatives, like credit default swaps, which were used to insure against defaults on mortgage-backed securities. When those securities began to fail, the credit default swaps market was not sufficiently regulated or transparent, contributing to the spread of the crisis.
The 2008 crisis highlighted the need for greater transparency and regulation in the derivatives market, and the Dodd-Frank Act included provisions to bring more oversight and accountability to these markets.
These reforms were aimed at mitigating systemic risk and preventing another crisis stemming from the misuse of these complex financial instruments.
Right, and it's important to remember that derivatives are just tools. They can be used for good or bad, depending on the intentions and actions of the people using them.
And while derivatives and other complex financial instruments have played a role in financial crises, let's not forget about the institutions that play a crucial role in navigating those risks and maintaining stability. Central
banks have evolved significantly over time, from their early roles in managing government debt and issuing currency. They've come to play a central role in ensuring monetary stability, promoting employment, and acting as lenders of last resort during financial crises.
They wield powerful tools to influence economic activity. They set interest rates, conduct open market operations to buy or sell government securities, and adjust reserve requirements for banks.
These actions influence the money supply, credit conditions, and overall economic activity. And in recent decades, central banks have implemented more unconventional strategies, like quantitative easing, to stimulate economies during periods of low growth and deflationary pressures.
Quantitative easing involves injecting massive amounts of liquidity into the financial system
by purchasing assets like government bonds.
It's a way to lower long-term interest rates, encourage lending, and stimulate economic activity. These unconventional measures have been used extensively in the aftermath of the 2008 financial crisis and during the COVID-19 pandemic. To support struggling economies, the role of central banks has become increasingly complex and crucial. In the modern globalized economy, they are tasked with maintaining price stability, promoting full employment, and ensuring the stability of the financial system. It's a challenging balancing act, especially in times of uncertainty and crisis.
Absolutely. And as technology continues to democratize access to financial markets, we're seeing the rise of a new force: retail traders.
The internet and online trading platforms have empowered individual investors to participate in markets like never before. Fractional shares allow investors to purchase portions of shares, making investing more accessible to those with limited capital. Commission-free trading has reduced the cost of participating in the markets, and social media has created new avenues for investors to share information and ideas.
It's an exciting development. This democratization of investing has the potential to empower individuals, but it also brings new challenges.
It's crucial to ensure that retail traders have access to the education and resources they need to make informed decisions and protect themselves from scams or risky investments. There's a lot of information out there, and it can be overwhelming for someone new to investing to know where to start.
You're right. Financial literacy and investor education are more important than ever. And as we look to the future of financial markets, it's clear that technology will continue to play a transformative role.
Artificial intelligence, blockchain, quantum computing, and other emerging technologies have the potential to reshape the way we invest and manage money.
It's an exciting and uncertain time. The financial world is constantly evolving, and the pace of change is only accelerating.
We've covered a lot of ground in this episode. From the barter system to the rise of central banks and the age of retail traders, it's been a fascinating journey through the history of financial markets.
It's a reminder of the incredible ingenuity and adaptability of financial systems. They've constantly evolved to meet the changing needs of economies and society.
But even as we embrace the future, it's crucial to learn from the past.
Absolutely. Understanding the mistakes and successes of previous generations can help us make better decisions today and create a more stable and prosperous financial future.
That's a great point. And on that note, let's wrap up this part of our exploration. We'll be right back after a quick message to dive into some of the trends shaping the future of finance. Stay tuned.
Welcome back to the Profitable Mindset Podcast. We've been on quite a journey, exploring the evolution of the financial market, from its humble beginnings to the complex global system we know today.
And as we wrap up this exploration, I can't help but wonder what's next. What trends and innovations will shape the financial markets of tomorrow? Any predictions?
Well, predicting the future is always a tricky business, but based on what we've seen throughout history, a few key themes are likely to dominate. First and foremost, technology will continue to be a major driving force.
We're already seeing the impact of technologies like artificial intelligence, blockchain, and digital assets. But what's really exciting is how these technologies are converging and creating entirely new possibilities.
Imagine a world where decentralized finance platforms, powered by blockchain, make traditional financial institutions obsolete, or where quantum computing completely revolutionizes the way we analyze risk and make investment decisions. These aren't just science fiction scenarios anymore. They're real possibilities that could fundamentally reshape the financial landscape as we know it.
It's both exciting and a little daunting to think about. How do we prepare for a future that's so uncertain, where the rules of the game are constantly changing?
That's the challenge and the opportunity that lies ahead. We need to embrace a mindset of continuous learning and adaptability. What worked yesterday might not work tomorrow. So we need to be willing to question assumptions, experiment, and evolve our strategies.
And it's not just about adapting to new technologies, is it? We're also witnessing a significant shift in investor priorities, particularly when it comes to sustainability.
You're absolutely right. ESG investing, which considers environmental, social, and governance factors, is no longer a niche trend. It's becoming mainstream as investors increasingly recognize that financial returns and positive social impact are not mutually exclusive.
I'm really encouraged by this trend. It's driving companies to be more transparent and accountable for their environmental and social impact.
And this trend is only going to accelerate as millennials and Gen Z investors, who tend to be more socially conscious, become a larger force in the market. Their values and expectations are shaping the future of investing.
So to thrive in the financial markets of tomorrow, we need to be tech-savvy, adaptable, and aligned with the values that are shaping the future. It's a lot to keep up with.
It is. But it's also an incredibly exciting time to be involved in the financial world. The opportunities for innovation and positive change are enormous.
We've covered a lot of ground in this episode, from the barter system to the rise of central banks and the age of retail traders. It's been a fascinating journey through the history of financial markets.
And it's a journey that's still unfolding. The financial market is a reflection of our collective hopes, dreams, and anxieties. It's a constantly evolving system that mirrors the complexities of the world we live in.
So as we look ahead to the future of finance, what key takeaways should our listeners keep in mind?
I think the most important lesson from history is that financial markets are constantly evolving. What worked in the past may not work in the future. So be adaptable, be open to new ideas, and never stop learning.
That's great advice. And remember that knowledge is power the more you understand about the history and inner workings of the financial market, the better equipped you'll be to navigate its complexities and make informed decisions.
Absolutely. And don't be afraid to seek out information and resources to expand your understanding. There are countless books, podcasts, websites, and educational programs available to help you stay informed and ahead of the curve.
We hope this episode of the Profitable Mindset Podcast has provided you with valuable insights and a newfound appreciation for the fascinating history of the financial market.
And that it's inspired you to continue exploring the ever-evolving world of finance.
Thanks for joining us today. We'll be back next week with another insightful episode. Until then, keep learning, keep growing, and keep that profitable mindset.
I'll see you next time.